am Ben Reppond. Today is June 14, 2023. Welcome to my YouTube broadcast. I'll begin with the dashboard. This is the view from last Friday, June 9th, and looking at the previous week, last week, and year to date. I put the week in yellow and in pink year to date. And this shows the numbers. Now, this is organized from top to bottom as year to date. So I'm looking at 6 major equity indexes and 1 bond index. And then in the far right, 4 columns are, is this index above its 20, 50, 100, or 200-day moving averages? So you can see that, and then I put a white line across the S&P 500. So you can see when you go down on the far right, those dots, the green and red dots, you go down, all 6 of the equity indexes, all but 1 are above all 4 moving averages. The last one is not an equity index, it is a bond index. It's the 20-year Treasury bond, and you can see, conversely, it is below all 4 of its moving averages. Now that's got a lot of implications actually, because last year, when you look back to 2022, what was happening is equities were generally speaking going down quite a bit most of the year. What happened is bonds and bond funds also went down last year, as much and sometimes more than equities. What's interesting about that is that, how long has that been? It's been a long, long time since that happened, because traditional financial advisory models say that bonds are designed, or probably will counter, most of the time will counter equity, not completely, but partially counter equities, so that when there is a decline, what you want is a combination of equities, stocks, and bonds. Well, that model didn't work last year. And so it caught investors and traditional financial advisors by surprise. So there just was no protection with the use of bonds. And then this year, when equities started to go back up, bonds stayed down. So they did not give, you got the negative side of bonds, but you didn't get the positive side. They countered equities, and so the rise in equities has been much slower in traditional 60-40 models, because bonds, or treasury bonds in this case, have been much below, quite a bit below their averages. When I go over to the S&P 500 and I break it apart, this is interesting, break it apart into its 11 sectors. So when you say S&P 500, that is doing X. But below that are 11 sectors that are weighted averages, and they make up the S&P 500. And again, looking at those in the pink box, this is year to date, you look at the pink box and you can see, where did that come from? Where did the gains in the S&P come from, and there were gains? What happened? What you have is 2 out of 11 contributed most of the gains in the S&P 500. Consumer discretionary and technology. 33%, 24%, and then it drops down to a 4% gain for the year in industrials. After that, it drops down to 1% or negative, all the way down to negative 7%. Most of the stocks in the S&P 500 are negative. And there are, according to Axios, there are, I think this was on June 1, there were 5 stocks out of 500 in the S&P 500 that were holding up that average. 495 were neutral to negative for the year. So the market in general has been negative, but you have a few stocks and a couple of sectors that are pushing it up. Interesting when you see that. And then you see the red dots there, very different than the previous chart where you see most of them, of the indexes, are positive, but when you break it down into the sectors, that is not the case. So, looking at the S&P 500 over the last 18 months, this is a chart, a weekly chart, showing the moves on a weekly basis, going from October of last year to current through last Friday. And you can see that it is, generally speaking, moving in a positive direction and is clearly above its 20-period moving average. When we take the S&P 500 and break it apart into two parts, not 11, but just two. We break it into two parts, the value stocks versus the growth stocks. Those 500 are made up of those two components. The growth stocks still are in an upward trajectory, generally speaking. I indicated that with the black arrow. So if it's going up, this is a ratio. So if it goes up, that's numerator, that's growth stocks. If it goes down, that's denominator, that's value stocks. So generally speaking, since the beginning of the year, growth stocks have been in favor. I put a box on this. I didn't put an arrow because there's no place, I don't see an arrow here. It just didn't compute that way. But from March forward, look at the S&P 500, this is the large cap stocks versus the small cap. The S&P 500 represented by SPY, the small cap represented by IWM, numerator, denominator. So in that period of time, look at what has happened with large cap growth. It's gone way up and now it's correcting, but way different pattern than prior to March. So I just thought I would show that. So in the short run, this tells you that small cap is coming back into favor, but over the past 2 or 3 months, I would say large cap is still way in favor over small cap. Now, we talked about bonds earlier. This is a chart showing TLT, the ETF TLT, which for an 18-month period of time, this is the 20-year government bond fund. So look at what happened from December, or you could say about December till now. Over that 6-month period of time, bonds have gone nowhere, putting a drag on traditional portfolios. So another reason why I don't believe in 60-40 or traditional buy and hold portfolios. What happened in the previous year in 2022, nobody saw that coming. What happened in 2023, nobody saw that coming. It's not a very pretty picture for a way to minimize risk and get some growth out of traditional portfolios. Okay, the dollar went way up until about October of last year, and then it corrected back down. So it is still in a intermediate term period of time since October. So I'd say, what is that, about 8 months? About an 8-month period of time, it has been generally in a downward trend. 12-month chart on gold, represented by the ETF GLD. You can see it is clearly in an upward trend from sometime in October until present. It's gone up and down some, but generally speaking, it's going up. Silver, same thing. Silver has more volatility. It moves up more and it moves down more. So you see that. But the same pattern of upward trajectory since October to present, about an 8-month period of time. When I put those on a relative strength chart, Silver's the numerator, gold's the denominator. You can see that silver, over that period of time, 8-9 month period of time, silver has outperformed gold, but it has also had more volatility. You see periods of time where gold goes into favor when it goes down, and when it goes up, shows silver is in favor. At the very end of the chart, you can see, relatively speaking, I'll show you this later, that silver has outperformed gold in the last couple of weeks. Bitcoin still has a generally an upward trajectory, but it has struggled lately. And but since the beginning of the year, it is definitely up from where it was before. It was had a very hard year last year. Volatility index. This tells an interesting story, because when volatility index goes down, that shows that there is less risk in the market, and equities, generally speaking, tend to rise as this falls, kind of inversely correlated. And so I showed you back from October to present, look at the drop in that, and that's quite different than the previous year. You can see how far away it is from my mark at 24. It's all the way down to 13. 13 is a pretty stable period. If it could stay down in this range for a period of time, this would tell you that it's probably a favorable environment for equities. Asbury Research does their metrics. They do the Asbury 6 using 6 different metrics, most of them fundamental metrics, and they have been, last week it was all positive, and this week it's all positive. All 6 of them showing that they're in a positive direction. When you look at, they break this down into, there are 3 columns to the right: weekly, monthly, and quarterly. And you can see that I focus on the ones that are green boxes for all 3 periods. And this compares different assets, one versus the other. So stocks versus bonds, stocks are in favor. No surprise. Remember the chart? Stock S&P was going up. The bond, TLT, was flat to negative. High beta versus low volatility. High beta stocks are more in favor. That's usually growth stocks, are more in favor than low volatility, typically value stocks. And in the bond area, fixed income, high yield is more favored than high quality. High yield is going up versus high quality, which is not, generally speaking. The U.S. versus the world. This measures on a relative strength basis the U.S. S&P 500 SPY versus the ETFs for each of these countries. In the second column, in the first column, you see all the names of all the countries that it measures against. Second column, you see the ETF for those countries. So just like we have SPY, which is a representation of our large cap market index, it's used commonly as a benchmark. Each of them have a similar ETF that represents their market as well. And the only 4 of them that are outperforming the U.S. is outperforming none of them enough to get a green box. And the 4 that are outperforming the U.S. in all 3 boxes are Taiwan, Mexico, South Korea, and Brazil. The strongest of these is Mexico. Mexico is killing it. They are quite a bit above, performing better than all the other countries. So I put this chart together. It's a relative strength chart to show you Mexico, which the ETF is EWW, when put in relationship to SPY, the S&P 500, EWW numerator, SPY denominator, look at how well it is doing versus the U.S. market in 10 months. Pretty amazing. And when even the ones like Taiwan, Brazil, they were, South Korea, they were not nearly as strong as this. Mexico was, in my opinion, it looked like the number one country in the world, and it's a developing country, way outperforming the U.S. Okay, gold and silver. These are prices as of last Friday, June 9th. And as you saw in the earlier chart, gold is up a little bit this week, 0.6% from the previous week. And silver is up more, which is why that relative strength chart showed silver up, had a higher gain. Silver was up 2.9%. And the gold-silver ratio is 80 to 1. A few months ago, it was 91 to 1. So this is definitely favors silver. A monster box, according to my son Preston, that he sells it for, a monster box is $14,375 as of last Friday. Prices change each day. That includes $4.39 for a markup over spot. We've seen what spot is. And so including the markup, the price per round for a box of 500 is $28.75, or at least that's what he sells it for. For a tube of 20, it is $29.25. So it's about a 50-cent difference there. And on the markup, I said this before, about half of it depends on the volume you're talking about, but a portion of it goes to the retailer and a portion goes to the wholesaler. So the retailer keeps, I'll say, approximately half of it, and the wholesaler gets about half. And what the wholesaler does with it, with the people up the food chain, I'm not sure about that, but I know that the retailer only gets a portion of that markup. I thought I would put this on here. These are, I've got copies of these. We have in our currency, we have what is known as a Federal Reserve note, and that is at the bottom. And what that means is, when you're holding a dollar, look at it, and at the top it'll say Federal Reserve note. What does that mean? It doesn't mean anything. It doesn't mean that that piece of paper is worth anything unless you and I agree that it's worth something. If I give it to you and you accept it and accept it that it's worth $1, then it is worth $1. But it has no intrinsic value. It's just a piece of paper. When you go back earlier, before they had the Federal Reserve notes, they had silver certificates. And silver certificates were backed by silver or gold. And then prior to that, they had a gold certificate, and that was actually backed by gold. In other words, it could be exchanged for its equivalent in gold. But we no longer have the gold certificates, and we no longer have the silver certificates. We have Federal Reserve notes, which are just paper. So when they print more of it, when they add these trillions of dollars of the Federal Reserve is pushing trillions of dollars more into the system, it's not even paper anymore. Paper doesn't even, they don't crank up the printing presses like they used to. They just hit a button and $1 trillion or whatever it is happens to appear in the system, of course devaluing the currency and causing inflation. But there's a lot to the history of this, but where we are today, the dollar is losing its value, and even though it's a piece of paper, it still means something because we agree it means something. I hope it gets to continue, and I hope they stop printing it and get rid of some of the printed money that's on their balance sheet. Thank you for watching. If you have questions or comments, leave them in the comment section below.